All right, let's jump right in. Have you ever been looking at a property and just felt totally overwhelmed? You're not sure if it's a golden opportunity or a complete disaster waiting to happen. Well, today we're going to break down the simple four-part framework that professional investors use to size up any deal, and they do it in minutes. Let's get to it. I mean, this is the million-dollar question, isn't it? Every single time you look at a new property, this is what you're trying to figure out. Is this the hidden gem I've been looking for? Or is this just a financial train wreck? It can feel like a total guessing game, but I promise you, it doesn't have to be. You know, the secret is actually a pretty simple and I think elegant system known as the 4 Cs. And this isn't just some textbook theory. This is the actual toolkit that seasoned investors are using every single day to make smart, profitable decisions. And by the end of this, you're going to know exactly how to use it too. So let's kick things off with our very first C, the capitalization rate, or as everyone calls it, the cap rate. Think of this as your starting point. It's like the first quick snapshot you take to get a feel for a property's potential. At its heart, the formula is really simple. You take the net operating income and you divide it by the total cost of the property. What that gives you is a percentage, and that percentage shows you the property's raw natural profitability, what people call its unleveraged return. Basically, it's what the property earns before any loans are factored in. And as a buyer, you're always looking for a higher cap rate. It just means you're getting more bang for your buck. But, and this is a big but, here's where the real work comes in. This formula is only as good as the numbers you plug into it. You have to be a detective and dig deep to find the true net income. And just as important, the real total cost. And that absolutely has to include any money you know you're going to have to spend on improvements right after you buy it.
So what's a good cap rate then? Well, here's a really powerful rule of thumb from the pros. You want to look for a 3-point spread between the cap rate and your loan's interest rate. So for example, if you can get a loan at 5%, you should be aiming for an 8% cap rate. See that? That 3% difference? That's where your profit really comes alive when you're using leverage. It's the key that unlocks a fantastic return.
Okay, let's move on to our second C, the coverage ratio. If the cap rate is mostly for you, the coverage ratio, well, that one's for your lender. This is all about financial safety. Just try to think about it from the bank's perspective for a second. They need to know without a doubt that you can make those mortgage payments, even if you hit a rough patch, like an unexpected vacancy. This ratio tells them exactly that. It answers the question, how many times over can this property's income cover its own debt? For them, it is the #1 measure of safety. This is exactly why people often call it the property's rainy day fund. That little bit of extra income, what's left over after the mortgage is paid, that's your buffer. It's your built-in safety net. And it's what gives the lender, and honestly, you too, the confidence that one bad month isn't going to sink the whole ship. So, how big does that rainy day fund need to be? For most lenders, the magic number is 1.2. What that means is they want to see that your property is bringing in 20% more income than it needs to cover the mortgage. If you fall short of this number, it's almost always a deal breaker. So this is an absolutely critical hurdle you have to clear to get your financing. All right, on to our third C, cash-on-cash return. With this one, we're shifting the focus away from the property and the bank and putting it squarely on what matters most to you, the return you're getting on your actual out-of-pocket investment. This metric answers the single most important question. For every single dollar I put into this deal, how many cents am I getting back each year? But the secret here is in that phrase, total money you receive back, because it is not just about the cash profit that you can go out and spend. A huge part of your return is something you might never even see in your bank account. It's this sort of phantom gain. Every single month, your tenant is paying down your mortgage, building your equity for you. It really is like an enforced savings account that can dramatically boost your total return. So what should you be aiming for? Well, in a really well-run niche, like the mobile home parks from our source material, a 20% cash-on-cash return is the benchmark. That means getting a fifth of your initial investment back in total returns every single year. That is a powerful yield, and it shows you what's possible when you find the right deal. And that brings us to our fourth and final C, cash flow. Now, it's super easy to confuse this one with cash-on-cash return, but they measure two very different and equally important things. So let's break that down. It's a really simple, but absolutely crucial distinction. Cash-on-cash return measures your investment's efficiency. It tells you how hard your down payment is working for you. And that includes those phantom gains we just talked about. Cash flow, on the other hand, is all about monthly profitability. It's the actual, spendable, take it to the grocery store money that's left in your pocket after every single bill is paid. And the great thing about cash flow is that it isn't set in stone. After you buy the property, you can actively work to increase it. Simple management moves like raising rents to what the market will bear, filling up any vacancies, or cutting unnecessary costs, all of those can dramatically boost the money you take home each month. So let's put it all together. This right here, this is your toolkit. You start with the cap rate to see if there's initial value. Then you use the coverage ratio to make sure the deal is safe and, financeable. Next, you calculate your cash-on-cash return to see how efficiently your own money is working. And finally, you look at the cash flow to see the actual profit you're going to earn month after month. Honestly, mastering these 4 metrics, that's what separates the amateurs from the professionals. You now have the framework to look at any property and actually understand the story the numbers are telling. So the next time you're analyzing a deal, don't just ask if it's a good investment. Ask, does the cap rate offer real value? Is the coverage ratio safe? And most importantly, will the cash-on-cash return and the cash flow truly help you achieve your goals?